Welcome to the Final Expense Sales Academy, the hub for mastering the art of final expense life insurance sales. If you're looking to become a pro in the final expense industry, you're in the right place. My name is Kyle Williams, and I'm your host to go through the ins and outs of the final expense business, from tips to tricks to industry insights. We cover everything you need to close deals with confidence, provide true value to your clients, and become a better insurance agent. So hit that subscribe button. Let's get started on elevating your sales game one video at a time. In this episode, we're going to talk about universal life insurance. If you guys are in a Facebook group with life insurance agents or any insurance agents, it is always comical whenever a post comes up about universal life. There's always hundreds of comments, and there's always constant arguing about which policy is the best. So in this video, I'm going to take just a minute, and I'm just going to explain universal life. A lot of people don't understand the components of universal life, so that way they can better understand it, and that way they can understand what everybody's talking about. So what is universal life? Universal life insurance is a policy that was designed around the 1980s, and what they did simply is it's just a hybrid policy, and they combined term life and whole life and put them together and created universal life. So they took cost of insurance from term insurance, and they took cash value from whole life insurance. So those are the two components that make up a universal life insurance policy. So what is cost of insurance? Cost of insurance is simply just how much it costs to insure an individual at a certain age. So cost to insure somebody who's 20 years old is substantially less than what it costs to insure somebody at 80 years old. So that's essentially all it is. Those are the two components of it. Now, the other wild thing about universal life is you can usually pick your premium. So you'll also sometimes see that it's called flexible premium adjustable life, just as what the name is. You can change the premium to adjust things. And really what it does is, and I'll explain it more, it'll make more sense in a graph that I draw for you, but essentially on the front end, you're just front loading the cash value account. Because then what the cash value account's doing is it's sitting over there drawing some sort of interest, some sort of way, depending on the type of universal policy that it is. So what are the different types of universal life insurance policies? Well, here's just a couple. These are the main ones. There's just a basic universal life insurance policy, which is usually a fixed interest accumulation amount. There's an indexed universal life insurance policy, and there's also a variable life insurance policy, and universal life insurance policy. So I'm just going to give some basic definitions about each one. So a fixed universal life, or just a basic universal life insurance policy, has a fixed interest accumulation rate for the cash value account. So you just have to look at the individual carrier to see what that interest accumulation is. They'll outline it there, and it just that cash value just accrues at that set interest over the time the life of the policy. Now, an index universal life insurance policy, what it does is the insurance companies accrue interest in the cash value account, mirroring returns from the S&P 500 or whatever index that it is mirroring. So it's not invested in the market, because you don't really invest in insurance policy, but it mirrors returns, and they deposit interest based off of that. Now, usually with an index universal life insurance policy, you can't lose value. So if the stock market goes down and the interest returns are negative, then there's just no interest accumulation in the cash value account. So that's typically how an index universal life policy works. Now, a variable universal life insurance policy, is a little bit different than an index universal life. So a variable usually have to have a different type of license. You can't just use a basic life insurance license to check with your state to see what the requirements are. But it is usually put into a security through the insurance policy. That's why you have to have an additional type of license, usually a securities license. And in that policy, you can generate substantial returns if it is put into the right security, but you can also lose money in that as well. So make sure you know the type of products that you're dealing with, but those are the different types of universal life products. I'm not here to say which one is the best and which one is not. I'm just giving basic definitions, so that way you have a decent understanding of it. So what we're going to do is I'm going to draw a chart of a basic understanding. Whenever I sit down with a client and I want them to understand the components of it and how it works, I'm going to draw the chart. I'm going to show you guys a chart. Use it with your clients so that way they understand it. A lot of times clients don't understand the universal life policy. So, and this can be used to help them understand that maybe that policy is not the best for them. And it can also be used to help sell the policy so that way they understand it. We're also going to review a universal life insurance policy so that way we can see what it looks like. We're going to look at a statement, an annual statement, so that way you know how to read the statement. And then we're going to talk about what you want to look for the policy to be healthy. Whenever you're reviewing a universal life policy that's already in existence, you need to be able to understand what's healthy. And this is also important too, because if you're going to solicit a universal life insurance policy, you need to know how to set it up so that way you know that it's healthy and you're not going to mess them up on the back end. We're also going to go over an illustration so that way you can understand how to read an illustration. Each carrier has different illustration tools. I'll use one that we have, and they basically have all the basic components, but it's more so just understanding how to read the illustration. So that's what we're going to do. I'm going to break off into a separate screen, and I'm going to show you all of that, and we will break those down for you, and hopefully you can learn a little bit and apply some of it. So I'll see you on the other screen in just a second. Here I'm going to go over the chart that I used when I'm actually explaining this to a client so that way they help better understand the actual universal life insurance product. And it's just a visual tool, and this will help you understand it so that way you can understand it to other clients, and whether you're trying to help them understand that the policy that they have now is not the best thing for them, or if you're trying to sell them a universal policy. This just helps them grasp the understanding of it. So when I'm sitting with the client, first thing I do is I'm going to draw a graph here. So on the two axes, we're going to look at time and money. Okay. And then what I'm going to do is I'm going to draw two lines. I'm going to draw one across here, and that is their premium. So let's just say their premium is $50. And I'm going to let them know that's their premium. And the next line I'm going to do is I'm going to draw like this, and that's going to be cost of insurance. And now what I'm going to do is I'm going to explain to them that when you first take out the policy, you're paying $50, but the real cost that it costs to insure you at your attained age, that when you take it out, is, let's just say, $5 for this example. So then the insurance company is going to take the difference, so the $45, and they are going to put that over here into a cash value account. So every month, that's going to go there, and it's going to build up over time. Well, as time goes on, the cost of insurance goes up. Okay, it doesn't go up linearly; it goes up exponentially as they get older. So, especially here, we're looking in this time period here, we're looking around the age late 60s, 70s, where it starts growing up exponentially, and up here is in the 80s. So, have that in mind whenever you're talking to your insurers. So at some point, the cost of insurance is going to meet the premium. So at that point, there's no more money going into the cash value account. So what happens then is usually a typical question that I ask, and they don't really know the answer. When I say, well, now your cash value is as high as it'll get with your contributions. So now what's going to happen is the next year, your premium is going to be $50, but your cost of insurance might be $65. So instead of them going up on your premium, all they're going to simply do is supplement the difference of your premium and the cost of insurance with the cash value account. Now, that's all fine and dandy, but what happens when you run out of cash value? What happens is the premium has to go up exponentially and do what I call staircasing to keep up with the cost of insurance. So once they increase one time on a universal life insurance policy, they're going to continually go up. So it's good to understand that. So then that way, when you're designing a universal life insurance policy, that you don't put the client in this scenario. Okay. Um, because at this point, you just overpaid for a term insurance policy. So you want to make sure that there is enough cash value in that account to pay the difference here over a long period of time. And that just comes off by running illustrations, which we'll go over. So now what I'm going to do is I'm going to go over a universal life insurance policy. So that way, if you get your hands on it in the field, you know what it looks like. And I'll also go over an annual statement that you may see in the field. So, or if you're consulting with a client via Zoom, you can catch it this way. So this is just a policy that I quick grabbed. I get my hands on quick just to go over this, but every universal life policy has pretty much the same components. You're looking for the same things. It doesn't really matter the name of the insurance company at the top. So some things that you want to look for. If you get the policy in your hands and you see flexible premium adjustable life insurance policy or universal life insurance policy, or index universal life insurance policy, you were looking at a universal life insurance policy. So just be on the lookout for that. So now what we'll do is we'll just skip through, and I'm just basically going through a policy contract that I have redacted down. So here we go. So what we're looking for is we're looking for certain key things. So we want to look at what is the premium that was set. So here we're looking at an annual premium of $661 a year. And then basically you can see the interest rate here, which is 2%, is what the cash value is going to be accumulating as a minimum. And then here now we can see the planned premium. So now we're going to see what they're actually paying. $55.10 is what they're paying every month. And then they actually outlay what the initial cost of insurance is, $7.84, with a monthly expense charge of $8.40. So you want to pay close attention to that because those are the fees that are associated in the policy. And then there's also a monthly administration fee. So this policy here is, for example, is laden with fees. So here we add those up. You have roughly $23 in fees with a monthly premium of $55.10. There's not a lot of gap there going over to put the money into the cash value account. So let's see. Let's go down here, and we will look at what we're looking at. So the face amount of the policy is $30,000. So we're gathering this information, and the policy started on May 28, 2022, and the individual is 54 years old. So now what we're looking here is this is just a cost of insurance rate. So now you can do the math on it. It's per 1,000, and it's just a formula. If you want to get nerdy on it, you can go add it in. But you can see how, based off that graph we laid out, once they get older, how the cost of insurance increases exponentially. So just by using the multiples here. And then also something to know in a universal life insurance policy is you need to be aware of the surrender charge. So if you're talking with a client and they are looking to move away from it, make sure you monitor what the surrender charge is. So like this policy here carries a surrender charge for nearly 19 years. So most policies usually carry it past usually around year 10, but every policy is different. So make sure you read the policy contract, or if you have to call the carriers, make sure that you know what that is. So that's just a brief how you go over a policy if you come across in the field. That way you're familiar with it. Now what I'm going to do is I'm going to go over an annual statement. So if I'm ever talking to a client who has a universal life insurance policy, to be honest with you, I would rather see the annual statement more than the policy. The policy is essential, but really honest and truly, the annual statement that they get mailed every year is really what is going to be the telltale sign of what the policy looks like. So here's just something I grabbed just to kind of go over, and we will go over this. So in the annual statement, this is just a very generic. It's going to have the company name on it. It's going to have the death benefit. It's going to have their premium listed on it, and it's going to have all the pertinent information there as well that all the policy contract holds. But what you want to pay attention to is the chart. So in this chart, you're going to have, and they may look a little different, but they're all going to have the same pretty much things. So you're going to have the payments. So what are they paying? What are the expense charges? So that's one of the fees. What is the cost of insurance, which is how much it costs to insure the individual? Is there any riders associated to it? And then you're on look at interest as well. So those are the things that we're looking for. Now, what we're looking for here is Another thing we want to look at is what is the current cash value. So if we're looking at this policy as of today, the current cash value would be $10,866. So that's what you can know. And you can look and see, well, what happened over the last year? Because that's dating back 1 year. Over the last year, it grew a couple $100. Okay, so that's good to know. Well, let's take a look at this. So right now, the total payments over the last year were $385. Interest expense or expense charges were $61, and the cost of insurance was $78. So let me do some quick math here. Essentially, $61 plus 78. The fees in this policy are $140. Okay, so roughly half of what the premium is. And then they had interest of $462 over the year that accrued. So basically into the positive that they're getting, that's 385 plus 462 minus 1. So you're looking, they're having a plus of 687, which that should reflect here in the cash value, which it does. It's roughly $600 increase. So that's what you want to look for. Now, every one of these are going to look different. So if the cash value is increasing drastically, that means there's a big difference in the payments and the cost of insurance. Okay, but if the cash value is staying about the same, then it's pretty much all close to the same. So the cash value is really not going to get much larger. Now, another thing to look for is the cash value decreasing? If the cash value is decreasing, now we know we're at the point of the graph where the cost of insurance has overtaken the premium. And now we know that it's taking away from the cash value. That is why that graph that I just showed you is so important, because what it does is it provides a visual aid to your client, so that way they understand that either if you're selling it to them, that A, the policy that you're giving them is great, or B, if the policy that you're looking at is not the best thing for them and they need to look at a different option. So this helps give a visual aid so that way they understand it. So that is how you read an annual statement. Anytime you have a universal life policy that they currently have in place, get the annual statement. That's going to give you the health of it, and it's going to give you a very accurate description. All right, so now what I'm going to do is I'm going to go over an illustration. I'm just using a very simple illustration here with Mutual of Omaha's WinFlex software on a Mutual of Omaha product, the Index Universal Life Insurance Policy. And essentially what I'm going to do is I'm just going to go over the basics. I'm not going to do anything drastic. So you universal life gurus, don't come at me. I'm just doing this basic so that way we can understand the basics of an illustration. There's a lot more complicated things that you can do, but if you can at least do the basics, you can at least make sure you're selling a policy that is going to last for the client and not set them up for failure. So now what I'm going to do is I'm going to go through just basically what are the components. Different companies use different software, but it's all pretty much the same principal information. So you're just going to put in the client's information, how old they are or their date of birth, their gender, and then what class you're looking at, and then the state you're in. And you want to solve for, like Mutual Omaha is an easy solve, which they basically use computer software to determine what the premium should be. So that way it lasts. And you solve for premium or the face amount. You can also solve the other way around. And then you can talk about your disbursements if you want to go into that. Index strategy, I'm not going to go too deep into this, but you can basically allocate how you want to do it. And then policy options here, not too much to change there. If you want to do any riders or not riders. And then we're going to go into concept, what we want to see. And then there's usually a little settings button here. You just press that, but I've already done it just to save time. And now what we're going to do is we're actually going to look at the actual illustration. So that way you can take a look at whenever you are selling a policy to make sure that it's going to last and how to go over it. So here, it's a long, lengthy, it's 37 pages. You can pretty much cut through the mud on what it would be on the first page. It's pretty much going to outline what the total death benefit is that you selected and what the initial premium outlay should be. So for this case, for a 52-year-old male, for $150,000, we need to be paying about right at $225 a month. So now what we're going to do is, and you can read all this, but what we want to do is we're going to save some time, and what we're going to do is we're going to look at the actual illustration so that way we can take a look and see how this thing's going to go. So like I said, it's way down here. Just scroll down and we'll get here. So this is what we're looking for. So this is how you read an illustration, determine whether or not this thing is the best thing for the insured. So there's always a couple different charts. There is guaranteed, there's alternative, and then there's non-guaranteed. Okay, so know your product. The non-guaranteed illustration is at 5.9%. Guaranteed is at 0. So for instance, we'll start in the 0 column. If you're looking at a bad illustration, your guaranteed would be, you're only going to have it for so many years. So this case here would only be good for 16 years, because what happens is when the cash value, the surrender value or accumulation value, hits 0, at that point, the insured has to supplement the difference with increase in premium. So once it hits 0, if they don't go up on their premium, this policy is no longer in force. They will lose it. So now let's take the alternative scale. Let's go over here. The non-guaranteed, where it's generating, this illustration is using 5.9%. So we're going to go over here and we're going to take a look at the accumulation value. So we see it going up, and we see it going up, and it keeps going up. So we're still increasing. Right now we're in the early 80s, and we're still going up. This thing has $86,000 in cash value. That's pretty strong. And let's see what happens what happens. So it keeps going up. It keeps going up. So now we're all the way where they're 112 years old, and we're still accumulating cash value. So if you were looking at this and you say, okay, well, this policy is designed great, and you can show this to the proposed insured and show them that this policy is going to last forever at this point, because it's just, it's just continually growing. So you can show them that. Now, just make sure they understand this on non-guaranteed, make sure they understand the policy specifics, but that is how you read an illustration. That's how you explain it to an insured, so then that way they can have confidence. So that way, if another agent comes in there and starts bashing your product, you've already went through it and they feel confident in understanding what you've went over. And then you feel confident knowing that you got them a policy that's going to last them the rest of their life. So that is how you understand an illustration for a universal life insurance policy.